Hello students, welcome to day 5 of Mathematical Theory of Interest course. In today's lecture we will discuss equations of value and the yield curve, or we can say that the yield rate. There is a very little difference between yield rate and the interest rate. First of all, we will discuss how we can calculate what are different equations are involved in calculating the value of money, and what is the yield rate and what is the difference between interest rate and the yield rate. So quickly moving to our topic, here are some important lecture contents. First of all, we will discuss the understanding. We will try to understand the concepts of the time value of money. In the previous session we discussed about the simple interest and the compound interest, and we discussed how we can calculate the total amount of by using the simple interest and by using the compound interest. Today in this session we will continue our discussion further to calculate the time value of money. Remember, in calculating the time value of money, we are supposed to calculate the first of all the future value of money, present value of money, present value of annuity, and future value of annuity. These are the four main calculations that we are supposed to do in time value of money concept. In future value, I will give you a brief introduction. Later we will discuss in detail. In future value, we will calculate the future value of today's invested money. For example, if you want to invest $1,000 today, and what will be its value after 1 year or after 2 years, how much will be the accumulated value, that will be called as future value. And whenever we are talking about present value is actually the current value of our future returns. For example, if you are asked to invest something today so that you will get about $100,000 after 5 years, then you need to calculate what should be the current minimum value of this investment in order to get 100,000 after 5 years. And present value of annuity are basically, in present value and future value of annuity are basically the continuous payments after fixed intervals. In case of insurance, for example, if you purchase an insurance, you are supposed to make equal payments for like 10 years or for 15 years or for 20 years, and at the end of 20 years you get your policy amount, you get your insurance policy amount. This is an example of annuity. In case of annuity, we have multiple cash flows. And we are supposed to calculate the present value of these cash flows as well as the future value of the cash flows. Now moving one by one, first of all we need to define the time value of money. So basically, before moving the concept, I want to ask you a question. Would you prefer to have $1 million now or $1 million after 10 years? Would you prefer or not? Definitely you will not. You will prefer to have $1 million today, not after 10 years. Why? Because of time value of money. Because after 10 years, the value of this money, after 10 years time period, the value of this money will become lesser. There are multiple factors behind that. In the previous sessions we discussed, in the growth of money chapters, we discussed in detail about what are the important functions and what are the important factors that may affect the growth of money. So basically, of course, we would all prefer the money now. And what does time value of money means? The concept that the money available today is worth more than same amount of money in future time period. This is the concept of time value of money. Why? Because a money received today can be invested to earn more and more interest. A money received today can be invested to generate more and more money tomorrow. And due to money's potential to grow in value over time period, these are the possible reasons why you need to you should choose to receive money today rather than in future amount. Time value of money is dependent not only on the time interval being considered, but also the rate of discount or the rate of interest while calculating the current and the future values. Based on this, we can use the time value of money concept to calculate how much you need to invest to borrow now to meet a certain future goal. We will take a very simple example. Here is a very simple example. You need to sell your car and you receive offers of 3 different buyers. The first buyer offers you to give you 400,000 birr, or you can say that $400,000 to be paid now. The second offer gives you $4,100 to be paid 1 year from now, and the third offer is $4,600 to be paid after 5 years. Assume that the second and the third offer has no credit risk. The risk-free rate is 5%. What offer should you accept? So here basically you need to make a comparison between all these 3 offers. The offer which is giving you the least today's amount is highest amount today is the best offer. You will select that offer. So first of all, while calculating the money, while calculating the time value of money, we need to define the interest rate. It is basically a rate at which is charged or paid for the use of money, and interest rate is often expressed as an annual percentage of the principal. Similarly, in the previous class, we discussed in detail about the compound interest and the simple interest. So I will quickly move on to the next topic, the important component of the interest rate. There are 5 important components of the interest rate that will affect the rate in interest. First of all, real risk-free interest rate, provided that there is no risk involved at all in your investment. The rate in that situation is called real risk-free interest rate. Normally we take the interest rate of government securities as a real risk-free interest rate. Expected inflation, default risk premium, liquidity premium, and maturity premium. These are the other factors that may affect the interest rates. You can just read out the details, and from the name it is very clear. This is very simple to understand. So I will quickly move on. Simple interest and compound interest, we are already discussed the simple and compound interest, so I will quickly move on. This is how we have calculated the simple interest with the formula. Interest is equal to P, R, and T. P is the principal value, R is the rate of interest, and T is the time to maturity. And about the compound interest, we already discussed in the previous session that compound interest is calculated on the total amount, not on the principal amount. Simple interest is calculated only on the principal amount. This is the formula. A is equal to P into 1 plus R raised to power T. Here A is the total amount, P is the present value or the principal amount, and R is the rate of interest, and T is the time period. The time value of money, or TVM, is a concept that is used in all aspects of the finance, including the bond valuation, stock valuation, like making any project management decisions, financial analysis of the firm, and many other. In every finance course, time value of money is used. This is like the base concept, just like economics. When we are talking about economics, it means the demand and supply is the main concept. Similarly, as far as finance is concerned, TVM is the main topic that must be discussed, or that is included in all kind of subjects, branches. There are many types of TVM calculations, as we discussed, like the present value of a lump sum amount, future value of a lump sum amount, then present value of annuity, and present value or future value, and the present value of cash flow streams. There are simple rules that we must need to remember while calculating the TVM problems. First of all, stop and think. Make sure you understand what the problem is asking about. So first of all, you need to clearly read out the statement of the question, so that you must know what is the real scenario, what is the real situation that you have been asked in the question. Second one is the most important one. Second one, you need to draw a timeline. You need to draw a timeline which include all cash flows and the interest and the time periods. Then you will write down the complete formula according to the situation given to you in the question. Either you need to write down the compound interest formula, or either you need to write down the simple interest formula, or the present value formula, or the future value formula, whatever, depending on the question's requirement. You need to write down the exact formula, and finally you will make your calculations and check your answers. These are the steps. For example, a very simple example is given to you about how much money will you have in 5 years if you invest $100 today at a rate of 10% rate of interest. So here it is not mentioned that it is whether this interest rate is a simple interest or compound interest. So whenever the situation happens like that, like it is not mentioned whether it is simple interest or compound interest, we are supposed to we by default we assume that it's a compound interest, not simple interest. Remember, whenever it's a simple interest, it will be mentioned. If nothing is mentioned about the interest rate, then we will assume that it's a compound interest. So first of all, we need to understand the situation. Here what we have been asked, to calculate the future value of $100 after 5 years at the rate of 10%. So first of all, we have understand the question. Now we will draw the timeline. So according to the timeline, at the 0 time period, 0 means today we have invested $100, and we are supposed to calculate its value after 5 years. So at 5th year we are supposed to calculate its value, and the rate of interest is 10%. The 5th year is our future value. So in this question we are basically asked to calculate the future value of your investment. So we need to use the future value formula. This is the future value formula. The future value at t time period t is equal to cash flow at 0 period multiplied by 1 plus r raised to power t. PVT is basically the future value. In this question we are asked to calculate the future value of time period 5. So we need to calculate the FV5. Cash flow at 0 time period is $100, R is 10%, 0.10, and time period is 5. Now we have easily understand. We will put all values in the formula, and we will calculate the future value. Now the future value, as I already told you, the future value is the value of an asset at a specific time in future. This is the formula to calculate the future value. The cash flow today is actually called the present value. So this is the more easy formula. It is same as the previous, as I discussed in previous, but it's more simple and easy to understand formula. FVN is equal to PV into 1 plus I raised to power n. Here FV is future value, I is the rate of interest, and n is the number of time periods, number of years, and PV is your present value. If we want to calculate the present value from this formula and future value is given, then it's very simple. We will just rearrange this formula to calculate the present value. The formula will be same, but we need to rearrange this formula. We need to calculate the future values of different types of questions. So first of all, the future value of a lump sum amount. How we will calculate the future value of a lump sum amount? This is the question. The previous example that we discussed previously is the question of calculating the future value of a lump sum amount. First of all, we draw the timeline, then we will write down the formula and insert the values, and finally we have calculated that after 5 years, our future value of our $100 investment will be $161.05. In case we have cash flow streams, we have multiple cash flows, then how we can calculate? We need to calculate the present future values of all cash flows separately, and then at the end we will just need to add up all these values together. The formula will be same, but the only difference is at the end we need to sum up all future values of all cash flows. That will give us the total future value of all cash flow stream. So for example, in this question we are given an investment which promises to pay $100 after 1 year from now, $300 2 years from now, $500 3 years from now, and $1,000 from 4 years from now. How much will be the future value of cash flow at the end of 4 years, provided that the interest rate is 10%, at the rate of 10%. Here we are given 4 different values and we are asked to calculate the total future value at the end of 4 years. So first of all, we need to draw the timeline. This is the timeline and we are supposed to calculate the future value at the 4th period. So we will calculate separately. For the first payment, we will have to calculate this cash flow is available at the end of first year. It means we have to calculate its future value for 3 more years. For 300 we need to calculate its future value for 2 more years. For $500 we need to calculate its future value for 1 more year. And 1000 is already at 4th year. There is no need to calculate its future value because it is already the future value at the end of 4th year. So we will calculate the 3 future values for $100, for $300 and for $500, and then we will add up all 3 values and the 1000. That will give us the total future value. This is how we can use this formula. And finally we can have the total future value, which is $2046.10. Now here is another example. You can just go through this example by yourself for your better understanding. Annuities are basically the same as the future value of cash flow stream, but here we have the periodic payments are same, they are not different. The periodic payments are same, they are not different. There are 2 kinds of annuities. First one is the ordinary annuity and second one is the annuity due. These are the most common annuities. But here is here are some other annuities as well. We have deferred annuity, we have perpetuity. We have deferred annuity and we have perpetuity. So these are the 4. The first 2 are the most common. Ordinary annuity is one where the payments are made at the end of each year, while in annuity due the payments are made at the start of every year. Deferred annuity is that annuity in which the payments are not made for a certain time period, then the payments will start. And in perpetuity the payments are made for unlimited time period or for infinity time period. Now here we need to calculate the present value and the future value of all these annuities. The same method we will use as we have discussed previously. This is the formula to calculate the ordinary annuity, present value of future value of an ordinary annuity, future value of ordinary annuity. We can use this formula by manual formula, or we can use the table formula as well. This is the broader explanation of or we can say that this is the expansion of this formula. But if you can understand this expansion, it's very good. But if you don't understand this expansion, it's okay. You just need to remember the formula of future value of annuity, FVA. Now, if you are asked the question, what amount will accumulate if we deposit $5,000 at the end of each year for the next 5 years, assume an interest of 6% compounded annually. This is the question given to you. This is the question is given to you. So what we will do, we will just make a table from 1 year, 2, 3, 4 and 5. At the start of first year no payment is made, so no interest will be earned. At the end of the year 5,000 is deposited. At the end, this 5-year opening balance will be 5,000, and now we will get the 3,000 interest at the rate of 6%, which is 300. And at the end of the year again 5,000 is deposited, so total balance in our account is 10,300. Similarly, we will make all calculation and by the end of 5th year we will have $28,185.46 in our account. This is the future value of annuity. Instead of this using the table, this will be very complex. We can use this formula to calculate the future value of annuity. By using this formula, the answer will be same. This is the alternative method. Here is the annuity due. In case of annuity due, the payments are made at the start of every year. So we have to calculate 1 year's extra interest. The formula will be same, only we have used an additional 1 year interest component, interest factor 1 plus I to calculate the future value of annuity due. Here is the example. From the example you can get more information, more understanding of this question. Here is another example. You can calculate the future value of annuity easily. So here the future value of deferred annuity. In case of a deferred annuity, we have to make some payments are made and then there is a gap. The payments may be started after a certain time period. So we need to deduct the interest payment or interest calculation for the time period in which the payments are not being made. This is an example of the deferred annuity. In deferred annuity, this is how you can calculate the formula to calculate the amount of a deferred annuity. This is all from today's lecture. In tomorrow's discussion, or in day 6 lecture, we will start our discussion from here. Thank you so much. Bye bye.